Mike Howell, Managing Director of Crossborder Capital. We're a fund management and research company based in London. My background prior to that was that I was at Salomon Brothers, involved in research, and what we focus on almost entirely is global liquidity and capital flows worldwide.
What's your macro thesis?
We think that the world economy is clearly stuttering. It needs a boost. Central banks have been behind the curve. They've basically been tightening too much collectively over the last few months. And what they're going to have to do is to embark on a major easing program. In other words, another QE. That is very bullish for gold, and it's pretty bullish for cryptocurrencies too.
Can you explain the context of China's slowdown?
Yeah, I think one has to go back actually quite a long time, and one's got to look at what happened to China starting in 2001 when China was allowed into the World Trade Organization. As a result of that, China built up a huge trade surplus over time. It developed China's economy. China became very, very export driven. And the US accommodated China. It accommodated Germany too, but effectively China was being accommodated by the US trade deficit. America is now saying enough is enough. They're no longer prepared to accommodate these big deficits, i.e. China's surplus, and this is the background to the the tariff dispute. China is reacting to that. America imposed 10% tariffs, I believe, on the 17th of September. Within 5 days, China had started to tighten monetary policy. Through October, China hit the monetary base very, very hard and curtailed liquidity injections into Chinese money markets. We've seen the biggest slump in liquidity in these Chinese money markets that we've seen for 5 years probably, and effectively that is slowing the economy hard. Now, if you look at the backdrop, not only is Chinese manufacturing slowing down significantly in the Chinese economy, but China dominates global value chains, in other words, supply chains globally. And as China has slowed down, world exports have also shrunk, and that has hit manufacturing companies worldwide, but particularly in those locations that are involved in these supply chains. In other words, Japan, Taiwan, Korea, and Germany. And those markets have been among the hardest hit through this slowdown. America and service industry generally have come out of this relatively unscathed.
What are market crevices?
We've described the market outlook, in other words, the stock market outlook, as a market which is generally rising, but there is risk of very sharp sell-offs, or what we call crevasses. To protect against that, what you need in portfolios is effectively more bond convexity. Now, what's the reason that you're getting these major sell-offs? The major reason really goes back to the restructuring of the global financial system, really in the wake of the GFC, the global financial crisis in 2008. We know there's a big build-up of debt. But debt needs to be refinanced. And the way to think about this is that the world financial system is no longer a new money raising system, it's effectively a refinancing mechanism. And if it's a refinancing mechanism, what you need is balance sheet, in other words, size. You're not too worried about the level of interest rates. So the focus that the markets have and the media has on interest rate cuts, we think are broadly meaningless. What you need to understand is the volume of liquidity in markets, in other words, balance sheet size, and in particular, if the private sector is not coming up with balance sheet, with central bank balance sheet. Now, the key issue with the private sector, which is what makes the whole system a lot more fragile and contributes to these crevasses, is essentially that there is a shortage of safe assets in the system. Now, what do we mean by this? Safe assets are basically high quality bonds, particularly treasuries, particularly US treasuries, but to some extent, corporate securities have crept into that collateral mix. And the reason they've crept in is there are insufficient treasuries in the system to provide collateral. Most lending now is collateral based. And the reason for that is that what you have are some very, very big new players in the markets, which we call corporate and institutional cash pools, that basically come out of foreign exchange reserve managers in Asia, or they come out of US corporates that are running major treasury piles of cash. And what they need are safe short-term assets to invest in the money markets. And effectively what's happening is that the bonds are being repoed and sold back to these CICPs. And that is the mechanism of refinancing. That works very well until you start to get collateral problems. And collateral problems can occur if you get an economic slowdown, for example, and the value of the corporate slice of that collateral tranche comes under pressure, and then the whole liquidity mechanism collapses. That's what we've seen a number of times. We saw it clearly in 2008 with mortgage-backed securities. We saw it again briefly in 2018 in December when markets sold off. And what's happened every time is the central banks have come in, particularly the Federal Reserve. And that's what happened through December and January. And this is the basis for a change in central bank policy now. They're beginning to realize they're behind the curve. Liquidity has been way, way too tight. And now what you're seeing is central banks beginning to ease, but the leader is the People's Bank of China.
How tight are the central banks?
One of the ways that you can gauge the tightness of the US system is to compare Fed funds rate, which everybody knows, with the term premia, which is a slightly wonkish concept, but it's the premium that investors are prepared to pay for long-term debt, long-term treasury debt in the US. You compare that to the Fed funds rate. Normally the two move extremely closely together, but effectively in the last 2 years, term premia have collapsed relative to Fed funds. The collapse in term premia is equivalent to a significant, or it implies a significant monetary tightening. And that monetary tightening could be equivalent, on our estimates, to a Fed funds rate which looks at around about 5 percentage points. So way, way above reported levels.
Has China changed its policy to reignite stimulus?
We think China has changed policy, and we think that the decisive move was around mid-May. Now, the geopolitical background at that time was right across the Chinese media. There were reports from Xi Jinping of 3 red lines that the Chinese put down that say they would no longer negotiate on these 3 aspects of the trade dispute with America. And those red lines meant that America effectively had to now yield. China wouldn't yield, and they're not going to go back on this because it would be a huge loss of face. So in other words, this seems to be a very significant watershed in the whole trade tariff dispute. What China did at the same time was to start to inject liquidity back into their money markets. Effectively, what they're saying is, we are ignoring trade, we are starting to stimulate the domestic economy, and we don't really care if the yuan now devalues. And the reality is here with us now because the yuan has broken 7 against the US dollar, the magic 7 number. China has started to plow money back through the money markets, liquidity injections by the People's Bank. That has persisted through May, June, July, and into August. And they're now backing that up with other measures of fiscal stimulus, infrastructure programs, and a lot more is likely in the pipeline.
How targeted is China's stimulus?
It is more targeted. It's looking much more at infrastructure programs as far as one can tell at the moment. It's been given certainly to the state-owned banks, and they'll be channeling it more into state-owned enterprise. Now, I want to stress here that this is not a first best solution, this is a second best solution. China cannot continue to keep getting growth through debt, we know that, but in the short term, this is the reality of that is happening. The Chinese economy needs to get between 6 and 6.5% growth a year. China has estimated that the trade dispute could cost it 1.5 percentage points in GDP every year that this persists. So it pushed the growth rate significantly below their targeted rate, and therefore they need to rebalance to get the growth rate up, and hence the stimulus. Other central banks will follow the Chinese lead simply because of China's importance in the world economy and the importance of the yuan in terms of a currency within these global value chains. Essentially what you're seeing at the moment is, as China has devalued and started to push in more liquidity, you've seen devaluations generally of companion currencies or peer currencies against the US dollar. Other countries that are experiencing fallout from the slowdown in China will want to try and boost their economies. And so we're starting to see an increasing debate in Asia and in Europe about easing monetary policy. Already a lot of countries, for example, Australia, are already doing that. The Federal Reserve has started to cut interest rates. But the most important thing that the Federal Reserve can do is to expand liquidity, and that's what it's doing. Now, the $64,000 question, which comes back to the dollar, is will America allow the US currency to appreciate? In other words, to put it another way, other units to devalue against the US unit. And The answer to that we think is no. In other words, there'll be a lot of pressure being put on the Federal Reserve now to try and cap any dollar appreciation by printing money. So effectively, we're in a currency war, and every currency, every economy is trying to leapfrog every other economy in terms of monetary ease. Who wins out of that? Financial assets should generally do pretty well, but the gold price comes out of this magnificently, and cryptocurrencies, which are a pure liquidity play, should do extremely well.
Will we see another coordinated currency accord?
We call this Shanghai 2.0, which parallels the Shanghai Accord that occurred in early 2016 following the G20 meetings. After those meetings, the G20 countries agreed to stimulate their economies, and that broadly came through in terms of central bank balance sheet expansion, or what we call QE. That launched an equity rally. Equity markets rallied strongly through the back end of 2016, through 2017, and until they hit the hiatus in 2018. This is happening again. It is not coordinated this time around, but it's coinciding. It's coinciding because every country is now trying to react to the slowdown, which we say is China-induced, by basically trying to stimulate their economies. And as each one tries to beg thy neighbor, so to speak, you get a general lift in liquidity worldwide.
What will the Fed have to do?
There'll be a lot of pressure now for the US currency to rise, particularly if other countries are beginning to leapfrog the US in terms of monetary easing. Therefore, the US has to keep up. And we think the pressures will start to build on the Federal Reserve and the Treasury to try and maintain dollar parity at current levels. And that will mean more monetary stimulus coming through. So there'll be a lot of pressure on the Federal Reserve to do even more QE. The point is, against this background, where generally central banks are easing, this is the environment where equity markets tend to do pretty well. The best time for investors in equities are when central banks are trying to stimulate economies that are very sluggish, such as now. There's a lot of competition now to see who can ease the most, and unless the US matches other major economies, you're going to start to see the US dollar rise, and that's something that the administration clearly doesn't want, so they'll be putting a lot more pressure on the Federal Reserve to expand their QE programs. In terms of what this will actually mean, we think there'll be a significant easing of policy. To try and put it into perspective, probably you're going to see the equivalent of 100 basis points off US rates. That will be bullish, certainly for the front end of the yield curve. It will mean that the yield curve likely steepens, and there is a chance that long yields could come down as well. But generally in this environment, when central banks are trying to stimulate economies that are very sluggish, equity markets are the big winners.
Will monetary easing increase growth or just asset prices?
Can we grow our way out of a slump with credit or debt alone? And the answer is probably not. But it does help to alleviate some of the symptoms. What you're likely to get is much stronger financial asset prices. In other words, if you look at equity markets, we can't expect very much from the E, but the PE can expand probably quite significantly. And generally speaking, as far as we can see, world equity markets, while not being cheap, are comparatively inexpensive. What the big danger for markets is if you get a major crack in liquidity, as we saw previously in 2008. Now, we don't think that's on the cards because basically central banks are now beginning to act. But that's clearly something one has to watch very carefully. Equity markets generally should do pretty well in this environment. And if we're correct that what we're looking at is what we've termed a quick recession, in other words, investors are prepared to look through the other side, what you could easily get is a rally in value or cyclical stocks, which have clearly been under great pressure in the last 12 to 18 months. If you look worldwide, we think there is scope for Asia to rebound based on this China reflation trade, and there is scope for Europe to rebound based on what the ECB is likely to do, and in particular, when Christine Lagarde gets in to the helm of the ECB, it is likely that there'll be some significant easy moves there too. I don't think there's any goods price inflation in the system. We're in a secular disinflationary environment, which is being compounded by the fact that you've got long-term demographic problems. There simply is excess supply in the world economy. Therefore, if liquidity goes into the system, what you will get is further asset price inflation, and that's the name of the game. there's a good chance that bond yields could go down. Now, this is a very dangerous trade, and I think that one has to say wholeheartedly that buying bonds on negative and very low yields on what could only be a 2, 3, or 5 year view is a crazy investment. But more and more investors are being browbeaten into doing it. And the reason being is that there is a shortage, a structural shortage of duration in the world economy, and particularly in the US system. And what that means is that the duration of US pension liabilities is, for example, around 20 years, whereas the duration of the assets is around 10 years. Now, a lot of pension plans have been holding off closing that duration gap because they fear, or they believe, that bond yields already are too low. But there's a pain trade. And the lower that bond yields get, the more that those plan sponsors will begin to capitulate and start to buy more bonds. And that's when you could get a downside flip. So there's a very clear asymmetry in the system because investors will be browbeaten into buying bonds as their yields drop. So it's what is called in the parlance negative convexity. And that could be a problem. So in other words, even though this environment would seem to be unfavorable for bonds, because normally when central banks ease, yield curves steepen, we could be in an environment where actually the curve steepens, but across all maturities, the entire term structure drops. Commodities, in our view, should go up. And I think there's a very interesting parallel here with maybe what went on in the 1930s. Now, it's always very dangerous to go back and look at history. But one of the things that seems to be underway is that the Trump administration is trying to divide the world in two. In other words, there's a China-based system and there's an American-based system. And in other words, there's a lot more that comes after this trade dispute. In other words, there's attempts to try and divide the world economy. And that was more or less what was happening in the 1930s. In that environment, in the 1930s, there was a scramble for resources. And that may be what's on the cards now. A lot of very intelligent commentators, I admit, take a very different view. And they say what's going on is that you'll see commodity prices collapse if China is decoupled from the US system. It's possible, there's a logical case for that, but I think the opposite could happen. And with a lot of central bank liquidity being plowed back into the system, I think it's much more likely that commodity prices will rise. The bellwether of that is the gold price. Gold normally leads other commodity prices by around 9 to 12 months, and I don't see any reason why this shouldn't happen now.
What about the US dollar?
There's a real risk here of the US dollar going up, and the dollar could easily overshoot, and that's one of the dangers one's got to be alert to, because a stronger dollar is unambiguously negative for global liquidity, because it represents a big monetary tightening. We think the Federal Reserve will try and stop that. It's not in the administration's interest to allow the dollar to appreciate, and we think the pressure on the Federal Reserve will build. Now, one of the things one's got to think about in the background here, both for China and for the US and for their political leaderships, they face elections, both of them, in the next 12 to 18 months. Even Xi Jinping, as it happens. Although he's been installed as paramount leader for arguably 2 decades, the reality is that he has to face the Politburo for very important debates in 2021. And China is trying to attain what is called middle income status on World Bank numbers. And that has been a goal for the Chinese administration. Xi Jinping needs to get that. He needs growth. Trump needs to be re-elected. He wants growth. So there'll be a lot of pressure on the policymakers to try and deliver growth for both those two economies.
When does the US-China trade dispute get resolved?
Trade is unquestionably the paramount issue, and markets are understandably skittish about a worsening in the trade environment. One looks at the media, the odds continually go up. Everyone's trying to make this trade situation look worse and worse and worse. But it's very much in China and the US's interest to resolve the trade issue relatively quickly, because both leaders need strong economies going into 2020. What we think the outcome will likely be is that probably by the end of this month, the end of August, come early September, the course will be set in terms of Federal Reserve ease. What you're already seeing in terms of the Federal Reserve balance sheet is a significant step up in liquidity injections. China, as we noted, is already doing that. We just got to wait for the ECB and Bank of Japan to come in. So in other words, liquidity is starting to flow into the system now, and it normally tends to lead financial markets by around about 3 to 6 months. And therefore, certainly by Q4, markets we think should be beginning to move strongly upwards again. I think we ought to be under no particular illusions that more liquidity doesn't create growth. It will stabilize economies, it can flatten out the cycle, but it doesn't increase productivity in any way, and it doesn't add to long-term economic growth. In other words, what it does is it affects, in equity markets, the PE multiple. It doesn't necessarily affect the E in terms of the long-term trend in the E very much. The problem the world economy has got is it's saddled by debt and it's saddled by aging populations, and the West is facing pronounced competition from emerging markets and China. And that broadly is why we've got a secularly low growth rate. Liquidity is not going to change that, but it may make us feel better.
Which assets should one consider buying?
What we're looking at is effectively a correction of the sell-offs. And if we're correct, and we've called this the quick recession, China is now easing and trying to stabilize its economy. What you will see is a lot of those markets that have sold off very heavily in the wake of this China slowdown are the ones that could bounce back pretty significantly. In fact, Australia's already had a very big bounce through this year so far, but you're likely to see Europe rebounding strongly, Korea rebounding, and Japan.
So what's your macro thesis then?
Punchline, unquestionably, is watch liquidity. Liquidity is the most important thing in the global economy and global financial markets right now. What do you buy? You buy gold. If you look at global liquidity, it's clearly a very difficult thing to measure and to monitor. We do that systematically and professionally, so we cover 80 countries worldwide. But clearly everybody can't do that. So what are the signs that liquidity is moving into markets? Broadly, what we would say is to look at probably three things. One is to look at the price of gold. Gold is a very sensitive asset class. Equally, I've mentioned cryptocurrency, but let's stick with gold. If gold goes up, it's a sign that liquidity is moving into markets. The second thing is to look at the slope of the yield curve. Yield curves always steepen 6 months after liquidity conditions start to improve. And that is a rule which has worked for 3-4 decades. It's a very clear rule. Steepening yield curves mean more liquidity, flattening yield curves mean tightening liquidity. Yield curves at the longer end of markets, so looking at the 5 to 10 year spreads or 35 spreads, are already beginning to steepen. And that's a sign that liquidity is bottoming out and picking up. And the third thing to look at, which is a sign, if you like, of tension or stress, is the corporate credit spread in the US. And the reason for looking at that is if that spread begins to widen out, there is a risk of a further crevasse in markets, as we warned, because the whole collateral system is fragile and it rests a lot on the integrity of US corporate debt, which is held as marginal collateral. So if credit spreads widen, then you could see a pushback and liquidity could drop. So what I would like to see is rising gold, steepening yield curves, and flat to narrowing US corporate spreads.